Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, my co-host, Nick Kosko. Welcome, Nick.
Hey, thanks for having me again. Looking forward to talking about our subject today.
Absolutely. So one of the things that we say that Dave Ramsey gets wrong, Nick, is that he doesn't account for our capital having a cost. He thinks you just spend cash and the cash really has no value or no cost. So, that's why you should spend it.
Yeah, it really ties into, the fundamental problem we're trying to solve with infinite banking, that we finance everything we buy. You pay interest to other people. That's the one that's easy to see. That's the one Dave really addresses with any merit whatsoever. And then the part that he leaves out, it just completely ignores, is that thing called lost opportunity costs, that when we pay cash, we give up the ability to earn interest or investment returns in that process. So that's what we're going to talk about today, right there.
Absolutely. So, Nick, if you look at a company, what if you could look at a company and you could tell whether that company was becoming more valuable or less valuable right away?
That tells me very quickly which one I want to invest in.
That's right. That's which one you want to invest in. So what we want to do is we want to talk about EVA, and then we're going to correlate it to your family's economy.
Jim, tell everybody what EVA is.
Economic value added. And basically, there's three components of EVA. Net operating profit after tax, or what's that called? NOPAT, right?
Okay.
Cost of capital, and then the capital employed. Those are the three components of EVA.
Okay.
And we need to talk about the origin of EVA, which was a consulting firm named Stern Stewart out of New York. And they came up with this concept of your capital has a cost and you have to calculate for that. There's a great article from Fortune magazine in 1993. Now, I know that's a long time ago. But what they talk about in this article is why you need to look at EVA, or economic value added. But what we want to talk about a little bit to lay the groundwork is we'll talk about economic value added for a company. And then why do we look at this for infinite banking and your family's net worth or your family's wealth? Make sense?
Yeah. And for all you in the audience, if you want to read that article, we'll have it in the show notes for this show. And if you're a current client and reach out to us as well, we can send that to you. Happy to share that information. It's a great, simple article.
Absolutely. So the article, I think one of the things that is kind of to summarize what happens in the article, or what they talk about, is Stern Stewart went down to these different companies, but let's take Coca-Cola. So they went to Coca-Cola in Atlanta, and they said they were analyzing the way that they deploy their capital, they account for their capital, just kind of their financing practices, right? And one of the things that they said was that when the company borrows money from the bank, obviously the bank insists on interest being paid, right? The bank would never say, hey, you know what, Nick, just pay us back that principal. We don't, the interest isn't important, or we don't need that. We're going to go ahead and let you slide on that, right?
Wait a second. You mean there's no such thing as 0% interest?
There is no such thing as 0% interest. And if you think that there is, and I've had people argue with this with me, then we can help those people too. We can cure them, but we always have one question that the smartest man that ever walked the earth asked that question. What was that question, Nick?
Do you want to be healed?
Do you want to be healed? That's right. So, all right. So they come in, they analyze their borrowing practices and everything else. So when they borrowed money from the bank, they paid the bank interest. When they borrowed money from the company, they didn't pay interest.
Yeah.
And so Stern Stewart said to Coca-Cola, to the executives, who owns the company? They said, well, the shareholders own the company, of course. And their question was pretty simple and direct. Why is the shareholders' money worth less than the bank's money?
It's a great question. I mean, the simplicity is frankly brilliant.
It is brilliant. So they said, of course, it's not worth less. And so they started to charge, they started to pay the company interest, i.e. the shareholders' interest, when they used their capital. What do you think happened to the stock price?
Probably went up a fuzz, didn't it?
So one of the really cool things on Coca-Cola is in 10 years, it went from $3 to over $80. All right. So let's just say that we're somewhere around what is that, 30, almost 30x is. Now think about that. We're going to relate that back to your family here in a second. Okay. So the cost of capital, and then how much capital is, how much capital are they using, right? Employed. Sure. How much capital is employed? So that's really important, because when I think of that capital employed, obviously it's the volume of capital employed, right? It wouldn't be the rate that capital is employed.
No.
Right? Okay. So back to the article for a second is there's a couple of key things that they say in this article, and they're very simple. One, and this is from the CEO of CSX. He says, how we use capital determines market value. Okay, now think about market value for your family is your net worth. It's your wealth.
Yeah.
Right? How you use capital determines your family's wealth. Is a translation if we're going to make it about our family, right?
Sure.
Now, we always tell people, and Nelson would tell people, you're in two businesses, whatever you do for a living, in the banking business. Okay. But he says you are in business. Okay. So your family is in business. By the way, CSX, just because we're talking about them, when they implemented or introduced their EVA program, their stock went from $28 to $75 in a short period of time.
But hey, let's remember the noise, the financial entertainers out there are telling you that your capital has no cost. It's worthless. So
that's
just
right.
These are big examples. So far, we've covered Coke, we've covered CSX, bellwether companies in this country. If we're running our own personal business, our home economy, we have to model people that are doing what we're trying to do. These are great. We don't want to model knuckleheads. We want to model champions.
Absolutely. So Nick, when we're talking to somebody about infinite banking concept or investing in real estate or buying cash flowing assets and not doing the retirement trap, right? But they're building financial independence and building financial freedom.
Yeah.
You're exactly right. Are we going to mirror somebody that is getting mediocre results? Or are we going to mirror people that are getting great results?
Are you coachable?
Yeah. Are you coachable? Because if you say, but you know what? I really like the way that these friends are doing this. Do they have any money? No. I really like my CPA. Is your CPA wealthy? No. Okay. So we want to mirror wealthy people, not people that we like or people that are having the same struggles or they're still in the rat race or still in the herd. If you're in the herd, I don't care how much money you're making, you are not free.
That's right.
Also, by the way, if you're a small business owner out there, and if you're a real estate investor, then you're a small business owner. Okay. And we're all small business owners because we all run these families like a business. Okay. But we want to do some of the things that big companies are doing, because just like we want to mirror wealthy individuals and families, we want to mirror successful companies.
Yeah.
That makes sense, right? That seems almost too simple, right, Nick?
Yeah. It's just kind of why we talk about hey, who else is doing infinite banking, right? You got every Fortune 500 company, every major bank. You got both the knuckleheads that ran for president last year, quite a few members of Congress, like I just think about like, do I want to be with the minority, the people going through the narrow gate, or do I want to go with the people that are going through, in the herd going through the wide gate? Nothing good comes from going through the wide gate.
Nothing good happens in the herd. Nothing. I mean, that's right. So when you think about what is your EVA, so creating value until you apply the true cost of capital to all of the capital employed. Okay, so that means when you're going to buy something, when you're going to invest in something or buy a business or invest in a business or an asset, you have to look at the whole picture, right? You would want to have all of the facts. So one of the reasons that we say it just doesn't make sense to put money into a qualified plan when you don't know, they won't give you the facts on how much it's going to cost you to get the money out. They won't give you the facts of how they're going to inflate that money over the next 20, 30, 40 years when you get that money out. Because they won't do that, we don't want to play. So you have to have all of the facts. So what's your true cost of capital? You said it earlier, but let's just go back to that. Okay. You know the cost of your borrowed capital, at least the short term, it's the interest that you paid adjusted to economists. Okay. So that's called what? That when you pay interest, it's the cost of your borrowed capital.
Cost of capital.
Right? Is the interest you pay.
Okay.
But when we pay cash, that lost opportunity cost, by the way, it's opportunity cost when you pay interest too, right? Because you could have used that interest to go do something else.
Sure. It's just where's the interest going to?
Where's it going, right? And what's the cost of that? Yeah. And then how much capital is tied up in your operation? The more capital that you have moving, the more money you're going to make, right?
No, I think another reminder for those of you that may be listening to this, new to this, we'll put a link to the video of the penny doubling in the show notes on this, and that'll help you wrap your mind around a little bit of, hey, cash has a cost. Like we'll help you drive that home for you a little bit too. We'll put that in there.
So what they talk about in this article, by the way, too, is they talk about the money that the shareholders provided. So in your family, what would you call that? Your income?
My income. What I'm putting in.
What I contributed to that money pool, right?
Yeah.
So then when I take money out of that money pool, I have to, if I just act like, again, if I put my head in the sand, and I just say it's not happening, it's not happening, it's not happening, then sooner or later, I'm going to have the negative impact. Yeah. But it's kind of like other things in life. Probably not going to be in your 20s where you're going to see this huge negative impact that you're going to see. Remember, there is a negative impact, but you're not going to see it. It's when you really start to calculate, hey, am I going to be able to ever stop working? Yeah. And that, people figure that out in their 40s, 50s, and they go, oh my gosh, I'm way behind. I'm not going to have that problem, right? Or I'm not going to be able to solve that problem, I should say.
They feel the time crunch.
They feel the time crunch, right? So, as long as you're not at least matching the investor's opportunity cost, then you're in trouble. Right? I mean, that's where Nelson says, hey, you got to pay yourself at least what the bank was going to charge you.
Right.
And if you understand all of it, you'll charge yourself more. Because I love when Nelson asked the question, Nick, if you own the bank, would you be okay with the bank earning a really high interest rate?
Of course.
Right. So, so we have to think about, those things. So what I want to do is I want to talk about your EVA and how that affects what we're trying to do. And what we're trying to do is create cash flow, right? Yeah. So if the price of our stock goes up, then we have more capital, right, to employ, right?
That's right.
So let's relate that to our personal economies.
Okay. Think of every dollar as a worker.
Exactly. They are your workers, right? You can create more when you're working, and someday when you're not working, then you can't create more yourself. So who has to create those?
Yeah, those do.
Your assets, right?
Yeah.
So what we want, in fact, that's the goal. The goal is for your assets to create dollars, workers, not your time.
We want our money working for us, not us working for our money.
Yeah. If we're going to get that handicap of yours down, Nick, we are going to have to cut down the amount of time. All right. So I'm just kidding, because I'm going to use that handicap in a tournament coming up here sooner rather than later. Okay. So when one of the important things in running a business and using EVA is we look at our capital, we look at the cost of our capital. We have a system. We have a monetary system of how money flows in and how money flows out.
Okay.
In our personal lives, the way most people do that is they let the bank do that, and their CPA and bookkeeper do that.
Yeah.
What we want to do is implement infinite banking concept as our personal monetary system. So then when we combine infinite banking and EVA as our analysis to grow our wealth, now we're running our family like a Fortune 500 company.
Now you can start really considering leaving a legacy. You can impact multiple generations, not just one, not just your own, multiple generations.
Multiple generations is exactly right. I mean, one of the things that's hard, and I get that it's hard, especially if you're in your 20s, 30s, is thinking about this legacy plan. Now, especially if you don't have kids. But as soon as you have kids, that legacy plan starts to form. You start to see a little clearer. And I'm going to bet by the time you're in your 80s, you're looking at that really clearly. But you're not just looking at your kids, because they might be in their 50s or so, or 60s, depending on how old you are. You're looking at your grandkids, your great grandkids, and what you want is you want them to remember who the heck you were.
Yeah.
Right.
I don't know my great grandfather's name.
Well, yeah, but if there was,
I don't get a check every month from him.
I was gonna say, if there was a check that came every month with his name on it, you'd remember his name for sure, right?
That's right.
Well, I mean, so the way that you run your company, i.e., your family today, builds your stock price, your net worth, and then that's going to create the legacy, right? And It's kind of like when we look at people and we talk about estate planning and not paying as much estate tax as we possibly can, et cetera. Well, that's assuming that we have a big estate to pass on. So we have to build that estate unless somebody gives it to us. Okay. So so far I've given up on that hope, right? But so if somebody's not going to give it to me, then I'm going to have to earn it. Yeah. And the way that I earn it is I earn it by doing things that other people don't do, right? Because I have to employ a strategy that is uncommon.
Yeah.
To get uncommon results.
That's right.
So economic value, Nick, is one of those tools that I can use in concert with infinite banking concept to separate myself, break away from the herd, break away from the rat race, and really pursue financial freedom.
Yeah. One of the ways you can keep score with all of this is, start a personal financial statement. right? Take measure where you are, start where you are. And then, if you need to hire a bookkeeper, if you need to hire partners, you got to start with the end in mind. You may not perceive that that's what you need yet, but hey, you need a path, right? You need coaching. That's where we come in. We're not CPAs, we're not tax strategists, tax attorneys and whatnot, but we can help you with this personal economy and the flow of the money. Cause that's ultimately what Coke and CSX started doing. It's just a process. It wasn't something big and fancy and complicated. It's just a process, and you can mimic that in your own economy. And that's what we do every day is we help coach people. These are the conversations at our respective dinner tables, with our kids, starting that early. And it's really a gift that we can give to people. It's really a gift that you can give to yourself and to your family's legacy, is to take control of that, wrap your hands around it. Don't worry about being perfect. Just think about what's the one thing you could do today that if you did, it would make all the difference in that path. Don't try to build the whole bridge in one day. So that's my 2 cents on it.
No, absolutely. Well said, Nick. And all right, so that's the message for today, and that article is gonna be in the show notes. And Nick, we normally have somebody giving a book recommendation, but I think last week or October 19th, Dan Sullivan and Benjamin Hardy came out with another book, which is excellent, and it's called The Gap in the Gain. And so I would highly recommend that book. It's Audible, it's hardback. I think if you buy it, you get some bonus materials from Strategic Coach. So highly recommend that book. And the other thing that we are starting, Nick, and maybe some people noticed it or not, we didn't properly kick it off, but we're going to end. I know it hasn't been obvious to people that I sometimes struggle with how do we end the show, right? Now, I'm very good at modeling what other people do. And when I find something that works, I go, that's what I want to do. Okay. Mm-hmm. So one of my favorite podcasts has a specific way that they end the show. Okay. So now we have a specific way to end the show. And the greatest recording of all time is The Strangest Secret. And that's Earl Nightingale from 1956. Is it 58?
Yeah.
56.
Yeah, I think 56.
Somewhere in there. Right. And if I'm a woman, I can get offended by the way he speaks at times, but just look past that, please, because it's the 1950s, so that's just, it was a different time. He's not trying to be rude or anything, but the strangest secret is how we're going to end each show. Now, Nick, how many times do you think that you've listened to The Strangest Secret?
At least a couple hundred. And I've read the PDF. I've got to be well into the dozens of times in a short period of time now.
Awesome. Ever get old?
No, I love reading it every time. In fact, we were just talking with a good mutual friend this morning about getting that PDF out and having it out front and center every day.
All right, Nick. So just like you said earlier, if you need some help with infinite banking, if you need some help with EVA, then go to our website, createtailwind.com, or send us an email or reach out to us or check out our YouTube channel, which is just Create Tailwind. Or keep listening to this podcast and subscribe to it. And if you'd be so kind, rate us as a 5 on your review, and we would appreciate that. And Nick, thank you for joining me today. And
my pleasure.
Let's end the show the way we're always going to end the show, with the timeless words of Earl Nightingale.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Thanks for listening to the Breakaway Wealth Podcast. Be sure to subscribe to this show wherever you're listening so you never miss an episode. If you want to start increasing your wealth building ability right now, go to community.createtailwind.com to join our free online community and get access to free, in-depth training designed to help you build real, lasting wealth. See you next week.